morning, folks. How are you? So we're looking at this NQ. Put 5 contracts on at market, and we will look for a stop. It's 79.75. We'll do 80.75. It's fine. All right, and then the best case scenario, I'm thinking for this setup is that right there. So we have 5 micros trading on a 1-minute chart, trading a turtle soup. So that's the buy side, taken right above here. We've had 2-stage delivery, meaning that we had these and then this high pierced. You see that? So it's 2 of them. Now this is one of those instances where you can use the 930 candlesticks fair value gap. So you would do it like this. Okay. As soon as you take out this low right there, I'll take one of the contracts off because that'll be enough to accomplish the method for like my objective. I like to look for something greater than my 37.5 handles, which technically already, we're there. So just for rule's sake, let's just do one of them here. So now we can bring the stop down. There you go. So now I can order out pizza dinner. And I followed the rules. And we'll see if we can get below 930's candle. Now it can color just outside of that box or the high of that, because remember what the old liquidity pool was up here. So that's completely permissible. We just don't want to see the bodies left on the outside of that orange box. See how it's behaving? Get back down in there. Very good. So now we want to see it work towards getting to the lower end of that orange box. And then once it goes through the low of it, then it's permissible for it to trade up to the low of it or into the midpoint. We just don't want to see any bodies laid inside of this portion here. Okay. This candlestick needs to come back down inside the 930 fair value gap. Now there's nothing wrong if you are looking at this and you see this as the first presented fair value gap right there. If you think that, that's okay. There's nothing wrong with that. So if you're going to look at this video and say, wait a minute, like, is this wrong by doing this and that? No, it's not. It says I'm showing you how when I use the look at the high. See that? 18.75. So it's 3/4 of a handle higher than that candle's high. So that would be enough for your first presented fair value gap in classic terms. Don't want to make the candles too narrow. Looks a little cleaner like that. I know you're going to be mad. This guy always ruins my scam. I want to be able to trick people. Scammers. Leave it like that. We'll put this up here like that. right. And again, if it takes the 930 low out, we'll buy one more there. And then we'll be sitting pretty decent for the morning session on a Wednesday of non-farm payroll. Come on. A little bit of dog whistling. Come on, get down there below 840. Come on. I'm the daddy. Yeah, this is stuff that ticks the guys off that like to use my stuff and pretend it was them. No, you didn't take the trade. You didn't trade it. You didn't manage it. You don't get the credit for it. All right, it should do it on this candle or the next. All right, see that right there? See what it just did? It came up and touched consequent encroachment of 930's candle. Fair value gap, rather, of this. So you want to see the body stay out of that area up there. And a little bit more. Watch the wick there. We don't want to see a body go above on a closing basis above its consequent encroachment. You know, already we're 100 handles gain. So that's certainly better than the 37.5 handles minimum objective. So you see how I'm using the framework for looking for setups that comfortably yield that much. Not demanding I only take trades that give me, 37.5 handles, but looking for setups that mathematically, the math behind the method only requires 37.5 handles net. But if you're taking setups that are above that, then obviously you have the best of both worlds. You have the mathematics behind the risk to reward ideas, one might say, versus the technicals, which are much, much more superior in regards to what it affords you in terms of a setup and its yielding profit. Okay, so we had lower quadrant, traded 2 here, mid quadrant, consequent encroachment, and getting touched one more time here. As long as it doesn't lay a body up in the upper half, it's fine. Makes you nervous when you see stuff like that, doesn't it? It's because your experience isn't where it needs to be yet. Over time, you'll see, you'll get it. That's the benefit of using these lower time frames, because it gives you a plethora of real world, real time, instant feedback using the concepts. Because if there is an algorithm, and we'll say that in tongue in cheek, if there is an algorithm, then all these things should repeat on all time frames, not just a favorite time frame. Dive down there. As a matter of fact, what we'll do is we'll do 2 contracts below the 930 low, and then leave 2 as a runner. See if we can get that best case scenario exit down there, which I'm not demanding it does that. These old bones are creaking today. There you go. It's a little too quick for old man. There you go. Why didn't it fill? Trading view. See, it lagged and then I didn't think it filled. So I hit it again and ended up closing the trade. But whatever, it's good enough, right? I mean, it's good enough. So what I'll do is real quickly go over once more. There's relative equal highs. So they sent it up all night long. And this is what I taught you this year. Buy side liquidity above there. And then when you open at 9:30, down here, they run it all the way up. They take that liquidity. They create a short-term little high right there. Retrace down. And then send it one more time to take out that high. That's 2-stage buy side rate above a buy side. And then sink it down. Attack the low at 9:30. Focusing on the movement around the price action at 9:30's fair value gap. First presented fair value gap in the classic sense is there, and it did it there. Okay, so for the guys out there that say it's all buying and selling pressure, please explain that to me in a way that's believable, because it just wouldn't be accepted any other way.